Yo, what's up, guys? This is going to be the last part to the market structure series in Forex Foundations. We're going to be going over liquidity grabs versus breakup structures, and then I'm going to be talking about the stuff from video 1 and 2 and kind of combining everything. I just recorded this video, and I started talking about something, and completely forgot what I was talking about. Completely forgot the reason I brought it up, and so I had to restart it because I sounded like an idiot. But anyway, so basically liquidity grabs happen most on the expansion piece of price, right? So you have expansion. This is in a downtrend, of course, and then you have retracement. Well, liquidity grabs happen most when on the expansion part. So and it's like when price gets real choppy, and I'll show what I'm talking about. Am I recording? Yeah, okay. So in theory, right, price gets choppy like it does right here. It gets taken out, creates an order block, and then price comes back to it. But there's still like highs and stuff in the way. You know what I'm saying? And those aren't major breakup structures. They're a breakup structure and you can trade from it. But if you're wanting to trade with trend, it's not something you necessarily want to be paying attention to. So the thing to take from this model would be that liquidity grabs happen mainly on the expansion piece, and the pullback, the retracement, is the minor structure. And then you have your highs in here and whatnot. So I'm going to go ahead and show that on the charts. So remember, choppy price, expansion, so liquidity, retracement's the structure. All right. So an example I love going to for this type of stuff is you can see price get real choppy up in here, right? And then it hits, making its order block through the real order block it reacted to looks like from right here. Yeah, it was like this one. All right. All right. So that's how the order block was made, and then price still has this, like, remember the expansion is mainly used as liquidity. So this would be the expansion here. So all these highs in here are the liquidity. Now, you can say that, all right, this high was broken. This high is broken to the upside. And now you can 100% trade this as a buy and trade it up. But if you want to trade with trend and catch swings, like if you caught the major move here, you're talking 500 pips, you know, down to, I think it was like right here. So you're talking 500 pips, and you could narrow it down to, like, I'm sure 1 to 100 somehow. So find another example on the lower time frame. I'm still on the higher. Okay, this isn't the best example, but it kind of in theory works a little bit. So you have your expansion and price is choppy, right? Price gets taken out, creates technically this whole push right here. This push up would be your sponsor candle. Price comes back, hits the open of the sponsor candle. In this case, would be the imbalance. Well, all this structure in here, oops, I thought I was on. All this structure in here is choppy, and it's on the expansion piece, right? So even though a high gets taken out and you can buy like right here and trade up, you want to be trading with trend. So it's not a major piece of structure, right? It's nothing crazy. It's not like a breakup structure of this piece, because that's an important minor structure break. So then you can get higher RR. And if you don't know about that, then I'll be going up later. But essentially, yeah, the expansion is used as liquidity, and the retracement is used as the minor structure. And then like you could have caught, if when you use this as the minor piece, you could have caught probably 5 pips is kind of fat. You could have caught a 1 to 30, no problem. So the takeaways from here would be 1, expansion price is the liquidity, like the liquidity being is in the structure pieces, the highs and whatnot. It's liquidity. 2, the retracement price is the structure. So if we come back down into here, if you were to play this real time, you would say price gets taken out here. This whole push up would be the sponsor candle. So I would use this as my area of interest. It hits the imbalance. Breaks minor structure. Here's your order block. Boom, something like this. Right. And there's a 1 to 40 plus, no problem. Because again, the expansion is the liquidity. The liquidity gets taken out. Now you have your order block area. Up in here, you still have highs, but it's liquidity because the expansion piece. It's not the minor structure you want to pay attention to isn't until the retracement starts to happen. And then you have a minor structure break. And now again, this expansion, the expansion down after the minor structure break, these highs are not break of structure. It's not price breaking up. It's not price breaking to the upside. So then because then if you think it is, then you're going to start looking for buys in here. It's not price breaking to the upside. It's not necessarily important structure. This is simply just liquidity because it's the expansion piece. And it's not 100% of the time that expansion is liquidity, because then that would say that reversals never happen. And obviously that's not true. There's a little bit more that goes into it, but you get the idea. The expansion is the liquidity. And this goes back to, in my first video, I talk about for the pullback to be legit, liquidity needs to be taken out. Time and distance, right? You can see the distance between the 2 points here. And so then let's go ahead and start talking about my other videos. You want to focus on the swing points, which is the high that took out the low, or vice versa, the low that took out the high. Right, so you don't necessarily, someone made a great point when they're asking about structure. You don't necessarily, in an uptrend, you don't necessarily know when the higher high is made until the higher low is made for it. And I'll show that example here. So you don't, let's say we're in an uptrend right now, right? Oops. Let me draw this out good. So here we have our expansion. Now let's say we're watching it in real time. I just accidentally deleted the text. Damn it. Let's say we're watching it in real time, price forming before us. We have all this going on right now. We don't know if this is about to be the high right here or not, because the higher low has to be made first. And the only way that this is the high that I just drew is if price pulls back down to here, takes out this liquidity, and then pushes back up. Because this could totally happen right here. Price comes, you think this is the high, and it's not. It keeps pushing up, right? And then it comes back down. It wouldn't look like they wouldn't come back down that fast in real time, but pushes back up. So in an uptrend, you don't know what the higher high is until the higher low is made, because it's the low that took out the high. That would be your higher low. And vice versa. In a downtrend, right, you think this is the high, right? I mean, you think this is the lower low. Well, then price keeps pushing through. And then it comes back and then pushes out and expands. So these would be the structure points right here, because you don't know when the lower low is set until the higher low takes it out, the high that took out the low. And again, if we go back to the first video, you want to have time and distance in between your swing points. So you can see there's a lot of time between the 2 points, and there's a lot of distance. And you also want liquidity, which would be in the form, of these highs right here getting taken out. So you want time and distance, and you want liquidity being taken out. And then once you take that into account, and you take that the expansion is liquidity and the pullback is the real structure, then you can now zoom into the pullback, find the structure break, and then trade the thing or whatever, the order block for your high ROI trade. You zoom into the time frames, find your major and minor structure, swing points, your minor structure, and then trade it down, keep going down until you finally get down to where price is at the lowest time frame for it, and you can trade your order block. So I'm gonna cap up structure right quick, and we'll be done here in a second. So the way you want to approach structure is find your swing points. This is like you open up a fresh chart, right? You want to look at it, blah 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 analysis, right? You want to find your swing points. And how do you find your swing points? The low that took out the high, comma, vice versa. The low that took out the high, or the high that took out the low. And now, how do you establish that that's the set low? Well, the real structure piece will have distance between its other swing point, and it will have taken out liquidity. So when looking for your swing points, you want to find the high that took out the low, or the low that took out the high. And you know that it is the real set low because it will have time and distance between the other swing point, and it will have taken out liquidity. And again, you don't necessarily know in an uptrend, you don't necessarily know when the higher high is made until the higher low is made and has taken it out. And vice versa. You don't necessarily know when the higher low is made until, the lower low is made until the lower high takes out liquidity, has distance between the swing point, and then takes out the lower low. And so then once you find your swing points, you want to identify, completely butchered the spelling, I think. You want to identify, and I butchered liquidity. But I'm a trader, man. I don't care about writing, right? I'm not going to have to worry about writing. I'm going to hire someone to do it for me now. But, all right, for all. You want to identify liquidity. Lick will be in the expansion. And that's not all the time, because so WWA has a thing coming out with Ream called Liquidity Inducement Theorem. Something that they're about to charge like $3,500 for. But anyways, I obviously I don't know what it is exactly, but I'm pretty sure I can cap it up right quick. Liquidity inducement, right, is the inducement of premature selling and buying. And I'll show an example of that on the charts right quick. Oops. So, for instance, if you were to take if you were to take this and say it was your order block, because you can see in here it took out liquidity right here. There's liquidity resting below it, which induced it. And this is actually in my buy and sell model, which I'll be making a video on later. There's inducement right here, premature selling. You can see that this could be seen as the order block. There's premature selling right here. You get induced, right? You get induced to sell. Okay, well then here it is again. This is the order block. Well, you've gotten induced to sell again. You know what I'm saying? When the real order block was like right here. So lit is basically liquidity inducement theorem or theory, whatever. It's essentially, remember how I said liquidity is only on the expansion? Well, liquidity can be created on the retracement in terms, it can be created on the retracement in terms of inducement, not necessarily resting liquidity. All this over here is resting liquidity. All of this is like induced liquidity. It's basically shorts being placed, and it's just stop losses all up in here. Stop losses just getting hit until it's finally the real move. So when I say you want to identify liquidity, that doesn't mean only the expansion liquidity. And we'll go over eventually down the line when we get into order blocks and my buy and sell model, we'll be going over inducement liquidity. So I probably just explained WWA's $3,500 course. And now you can set that money aside, put it in an ETF or some sort of index fund, get 10% on it annually a year, and chill out. Get that compound going, that compound investment. So you want to identify liquidity, which would be liquidity and expansion. But that does not mean inducement liquidity also. So we'll put that in there. So you have your swing points. You've identified your liquidity. Now you have a basic idea of where you want to be looking for your order blocks. And we'll go over that down the line. But now that you have a basic idea of your order blocks, you mark them out. Now you wait for price to return. So you have your expansion. Now what you're doing is you're waiting for the retracement because you want to trade with trend, right? So now you're waiting for the retracement. And then you want to identify. Yo, I'm not this trash at spelling. I'm just mistyping. I am that trash at spelling. Identify. That's how I spelled it. I accidentally typed them in. I'm just mistyping. Now you want to identify swing points for that. And then you want to identify those retracements. Essentially, minor, major structure. So what I mean by this is in video 2, I talk about major, minor structure, how your major structure is the swing points and everything in between them is minor structure. So you have your swing points here. Well, on your retracement, remember how I talked about your retracement being the structure that you really want to pay attention to. On the retracement here, you have your structure, right? And you want to zoom once you identify your swing points, which would be boom, boom for this timepiece, right? It would be the expansion structure piece here. And you identify your liquidity, right, which would be in here. Let's say you knew how to find order blocks too. So now we have our order block up in here. Now we go to step 3, you wait for the retracement. Well, clearly this is looking like a retracement, right? So then all you want to do is you want to repeat the exact same process, which is now you want to find your swing points for this retracement. Wait for the break of structure so your lower time frame trend matches up with your higher time frame trend, and then trade that. So you have your low, high, and then you wait for this structure piece to break so it matches up. You find your order block to trade it, and it doesn't necessarily happen as clear with this piece of price, but you get the idea. All you're doing is you're basically just zooming down and repeating steps, finding your swing points, identifying where the liquidity is, so then you have an idea of where you want to look for your order block, and then waiting for the retracement. And that's how people go about hedging, and that's how they zoom into the smaller time frames and find they get the high RR trades. So yeah, to cap over the video, your expansion's liquidity. You probably want to write this down or something somewhere. The expansion price is liquidity, but that doesn't mean that the retracement price cannot be inducement. So your expansion price is liquidity. Your retracement price can be inducement. Induced, hits the order block, trades down. Your swing points are the high that took out the low that took out the high, but you don't necessarily know when the higher high is made in an uptrend until the higher low is made and it's taking it out. And you go about finding your swing points through time and distance and liquidity that has been taken out. And then you're going to want to find your liquidity, which would be, again, you want to be looking for it on the expansion. Once you do that and you have an idea of your order block, you wait for the retracement, which is the structure that you really want to be focusing on so you can scale in and get higher RR. And then you do the same thing. You find your swing points, the high that took out the low that took out the high. And again, it's only valid if some sort of liquidity has been taken out alongside of it. And then identify your liquidity, find the order blocks, wait for the retracement, trade it, blah, blah, blah. You get the idea. That's going to be it for this video. The next video I'm going to be making it'll actually be a trading plan. No. I need to make videos before that. The next video I'm going to be making will be going over order blocks and how to correctly identify which order block is valid or not necessarily valid, but will be most likely valid. And I'll be going over my buy and sell models. It'll probably rival WWA's lit theory or theorem, whatever they're doing, because it'll be going over liquidity inducement and like inducement traps and all that. And yeah, it's gonna be a good order block video. If you combine the order blocks with market structure, you'll be a killer. But that being said, I think that's going to be it for this video. After the order block video, I'll be making a trading plan video where it'll be incorporating the buy and sell models, psychology, risk management, kind of like time frame trading, and just, I guess, how to approach the market and the mindset you want to have when you sit down in the morning or whenever you trade, and when you sit down and you go to trade. So it'll be a good video. After that, I'll probably go over Wyckoff, and yeah, that'll probably be it for Forex Foundations. Unless if anyone has any ideas, drop them down in the comments, or not ideas, but things that you would like me to go over. And if you have any questions, drop them in the comments or message me on Instagram @Vaxer. Yeah, so I can think of for this video. That's gonna be it. Again, no editing. Peace.